This is Tom Graffeo with Applied Financial Planning, and today is June 11th, 2012, and I thought I would take a minute to go through some slides of some information and some data and let you know that we're looking at as far as economics are concerned and considering things here for the summertime. This summer, I'm again looking forward to spending time with you as we have our summer meetings that'll get into the end of the year. The big events that we're dealing with right now are much of the headline news that we all have to deal with, and that has appropriate reason to be concerned in your portfolios. So I thought we'd take a few minutes here, maybe about 8 to 10 minutes, and go through this presentation, show you what I'm thinking about and how it might be affected in your portfolios and how we can be of service going forward. So here's the first slide. This talks about Fed funds rates and the 3-month Treasury bill. As you can see, both of those look very similar, right? They go back to the, on the left, the early 80s and the 90s on the right. Fed funds rates are the rates that the Federal Reserve Board charges member banks to borrow money from them. So when they want to lower interest rates, it makes it very easy for banks and cheap for banks to borrow money. Well, no surprise, we've seen since 2008 very low interest rates from the Fed because they're trying to stimulate. First, it was trying to add liquidity to the system, and then it was trying to get the economy back after the liquidity event of 2008. Well, having had that all happen, you can see that there's not a lot of room left for the Fed to lower interest rates. So that's why they keep looking at other things. And if you've been to any of our events and we've heard us talk about quantitative easing, the Fed knows this chart all too well also, and they've looked at other ways of lowering interest rates. There's not a lot of room between where they're at and zero, and they know it, and they're probably more than a little bit concerned about it. What the Fed funds rates translate into is low interest rates for borrowing for the Fed, and also the T-bill, so therefore the 3-month T-bill yield. Again, not quite zero, but virtually zero. It's actually at select moments touched below zero, where you actually would pay for the government to hold your money instead of them paying you interest. A bit of an unusual thought for American investors, but the bottom line here again is that this makes it tough to earn reasonable returns in a short period of time in a liquid type of investment for our clients. And so again, it makes us look for alternative investments, alternative methods. It should be ultimately a very opportunistic move for the markets and a very good move for the markets, but we haven't seen that translated out recently due to other headline news that we'll get into. Okay, so here's global yields, and you can see, no surprise from the last slides we saw, that the United States has some of the lowest yields in the world. Perhaps the only one that didn't make this chart that would have had lower yields is Japan, which probably starts with a 0 and not a lot after that, so 0.5 or 0.4 or something like that. But the 10-year sovereign notes, so those are United States Treasury or Canadian Treasury or UK notes, would be, you can see here that we have some of the lowest yields, again 1.9%. Think about the United States government can borrow from the world at 1.9% for 10 years. Well, that should be a very strong sign of economic growth. If we can borrow money that cheap, that we can put it to good use. The problem is, as we all know who's listening to this, we're borrowing a lot of money, a lot of money, more than ever. And so we need the yields to be low, artificially low I would add, so that we can actually afford some hope of making the interest payments without just producing more and more money to make the interest payments. So again, hard to make a good return for investors in the bond market. The Fed is making it painfully so that you don't want to have too much money in low yielding things. So it makes you want to look towards the stock market. Well, let's take a look at it. Here you can see the operating profits and the operating margins of corporations. I like charts that look like this. This is going up nicely. You can see that from 2099 on the left side when we look at operating profits, In the post-internet bubble age, operating profits went up very nicely for a long period of time until the 2008 liquidity crunch hit and went down severely as companies cut back, people stopped spending, and layoffs happened across the United States, where we had double-digit unemployment, and we seem to be pulling ourselves out of that. But operating profits for the large S&P 500 companies, notice it says ex-financial, so that's taking out banks and brokerages and insurance companies, has been increasing nicely, which is a very, very good sign for investors. On the right side, you can see the margins have also been increasing and kind of to some degree reflect the same chart on the left side, that the margins that companies are making more and more money. So this is something I would look at and say, boy, this is a great opportunity to invest in stocks. And looking at this would make me want to invest in stocks, and somewhat quite aggressively, because companies are very healthy. And we do know that, and companies underlying are very healthy. Here's the problem. It's the VIX. The VIX is the volatility index. And you can see that there's been, over the last decade, some very, very severe spikes. Certainly the Lehman crisis in 2008 was the biggest spike. We've also had the start of the Eurozone crisis, which we've been playing along and watching that for over 18 months now. And now the U.S. credit downgrade, which increased volatility. And conversely, somehow made the dollar more valuable and made the bonds more valuable, because the thinking apparently was, well, if the U.S. is in that bad a shape, everyone else is going to be worse, so let's go buy the U.S. stuff. But the volatility has been something we don't watch, definitely, and I think the volatility is the thing that keeps all of us up at night. This is the counterweight and the counter argument to why we would want to invest gung-ho in the stock market at this time, because we think a lot about volatility and the risk of losing significant portions of our clients' assets. Well, let's take a look at what's been on the headlines, and let's digest the headlines a little bit for everyone and what the big problem is in Europe. We'll take a couple slides here to take a look at this. So here's the Eurozone, and on the left side you see what's called GDP, Gross Domestic Product. Econ 101 teaches us that means how much all the hands and machines and all the people in each country produce an output. What is the gross domestic product? Means how much is the output of the manufacturing and services capability of a country. So of Europe, Germany is 27%, or the largest percentage of the output of Europe. France is close behind at 12%. And we see Spain and Greece, which have made headline news recently. Now Greece is relatively small at 3% of their GDP. We'll see how that plays out in a second. But over the weekend, Spain at 12%, or really the fourth largest here behind Italy, in third position, recently had to go to the Brussels European Bank and get a bailout for themselves. So the danger is that it has, before, much of this has been limited to a very small percentage. Ireland, Greece have had problems, but now a rather large GDP producer in Spain has needed help and gone to the central, can't call it a bank, I guess you'd call it the Central Monetary Authority, and gotten a loan to bridge themselves $100 billion. That it's one thing to have the threat of the need that you might need it. It's quite another to actually go to the window and ask for the loan. I take this as a rather cautious or a move that once you cross that line and you go ask for money, as Greece has done, you may have to go back a couple more times, and I find it problematic. And talking about problematic, here on the right-hand side, let's take a look at this Eurozone debt. Right in the middle, you can see two very awkward-looking lines, Ireland and Greece. When you look at the orange line indicates how much debt they have as a percentage of GDP. So you'd want this number to be relatively low. You would want this orange line to be less than their output, or less than something, I don't know, like Italy or France, or particularly even better Germany, right, where they owe less than what they produce. You can see for Portugal, Ireland, Greece, even Spain, that they owe a whole lot more by orders of magnitude than they can produce in any given year. So to put that in terms that everyone who has a credit card can understand, imagine you make $75,000 a year in your job, but that would be the solid, darker part of it, what's your gross domestic product. But you owe the credit companies $300,000 in credit card debt. How are you ever going to pay that off? Well, everyone knows that that's a pretty tough road to go down, right? If you make $75,000 a year and you owe your credit card companies a revolving debt of $300,000, well, in certain cases, by comparison, that's kind of the same thing that Portugal, Ireland, Greece are in, and to a lesser extent Spain. So this is the problem, and this is what keeps the European folks and much of the international bankers up at night. So in the face of all that, and also due to housing problems and all the other domestic issues, you can see consumer confidence in the United States started waning in 2007 as a real estate bubble started to burst and has went down a pretty significant slide. And then after 2008, when Lehman and all the other financial crises hit, has kind of perked up, boiled along there on the bottom. There has been a recent kind of perk up in consumer confidence. There has been a little bit of unemployment better news, let's put it that way. If you've been to any of our events, you would understand that it can consider the source of the information who tells you that the unemployment is getting better, right? So there's a lot of things that go into that, and I'll be looking forward to seeing you at the halftime events to talk more about it. But the bottom line is consumer confidence is not near where it was. It's off its 10-year high. It's off its long-term average, but it has had a bit of a trend of positive movement, and let's hope that continues at this point as consumers lead the United States economy. Payrolls are also increasing and perhaps driving consumer confidence. You can see that payrolls bottomed in 2008 as companies cut their employees out, unemployment shot up, and then private payrolls have been, and companies have been rebuilding their staff and bringing people back. This is probably one of the most positive things besides the company profit margins and operating margins. This again is another good indicator about overall payrolls, that people are making more money in the jobs that they've had typically.